Hello traders, Gary Wagner here. It is 12:50 in Honolulu, 5:50 in New York on Wednesday, 11th day of January 2023, and this is the Daily Report for gold and silver. It seems as though trading activity was extremely muted as market participants wait for tomorrow's CPI report for December, although it is expected to show a decline to 6.5% year over year, considering that inflation was at 9.1% in June. That is a confirmation that the Federal Reserve is making some headway. Muted price change is the overall characteristic today. Gold futures, basis the most active February contract, is up $3.20 or 0.17%. Spot gold is up by 0.0% or 10 cents and fixed at $1,875.20. Silver is down by about 0.5%, a decline of 12.5 cents, with the March contract currently fixed at $23.54. And lastly, an unchanged dollar off by 0.01%, with the index fixed at 102.97. Traders, as promised throughout the week, I want to look at different models we are currently looking at to forecast the future direction of gold. Today, I do want to bring in a couple of technical indicators that I believe will work in unison in terms of our current forecast. First, the moving averages. On this daily chart, we have three: the most short term, a 50-day, in blue, a 100-day, and the longest term, a 200-day moving average in red. Very interesting is the fact that we've had this steep upward slope with the 50-day moving average, and it is pretty much exactly at the same price point as the 200-day, meaning it seems as though a golden cross between the 50 and 200-day moving averages is imminent. We are not in full bullish alignment yet. For that to occur, we would want the highest value to be the 50-day, followed by the 100-day, and below that the 200-day moving average. Currently, we are just coming out of a full bearish alignment because the 200-day moving average is still the highest value. The reason that we're seeing this between the 50 and 100 is we recently had a golden cross between those two moving averages. What that signals is that there is a potential for this rally to continue. However, there is a huge caveat, and that is moving averages by nature are lagging indicators. Early on in my career, one of my mentors, Larry Williams, told me a story to express why a lagging indicator has very little validity in terms of predicting forward pricing. He said a moving average is like sitting at the back of a boat and looking at the wake created by the propellers and using that to determine where the ship is headed. That wake is telling you where the ship has been, not where it's going. Only the captain knows when he will turn the wheel. We have to take it with a grain of salt, but it is telling us that that momentum to the upside is still there and remains strong. One of the technical studies I am most fond of to determine direction of trend and, more importantly, strength of trend is a Japanese average chart, or Heikin Ashi. We have that up on the screen. You can see that although we've been in a pretty steep uptrend, we can easily identify that the real bodies of the most recent candles have different sizes and a multitude of different sizes. Take, for example, the rally from $1,620 to $1,795. You have consistently large-bodied candles with all of them except for the pivot candle here having no lower wick. The reason that is important is if you have during an uptrend a green candle with no lower wick, it says that at no time during the trading session did prices go to or below the midpoint of the prior day. When a rally is composed of long-bodied candles that tend to grow for a period of time and then diminish, such as here and here, it tells us that in these two instances, the uptrend was extremely strong. Compare that to what we're witnessing now, where many of the body sizes are small. Many of them have both upper and lower wicks. That is an indication of a diminishing strength in the current trend. And it is for that reason that the current formations we are looking at in the Japanese average chart with different body sizes with upper and lower wicks compared to a strong rally which contains no lower wicks and large bodies paints a different picture. So although we are eminently going to see a golden cross, that lags behind any type of real-time data, and I believe we get a much more accurate picture of the strength of a trend through the Japanese average chart. Lastly, I want to address and answer a question that has been raised by a couple of different subscribers in regards to our trade alerts and the absence of trade alerts through the end of last year and the first week or the beginning of this year. First, we did go on a shortened holiday schedule beginning in Thanksgiving, which is why we stopped doing trade alerts through the end of the year, as well as the first week of this year. First, we do plan on returning to the practice of sending out trade alerts via SMS text message and emails, but what is most important to us is that if you can spend a few minutes to go through the members survey and give us an idea of the importance of different components of the members page to you, our subscriber, we will be able to tailor the gold forecast to best meet your needs. A link to the survey can be found in the proper action section of the members page, and please spend the 3 to 5 minutes to complete the survey so that you can be heard and influence how the member page looks and the information it contains moving forward. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.